Hello, everyone. Welcome back to the Weekend Charts. I'm your host, Charlie Bilello. As always, I'm going to run through some of the most interesting charts and themes that we're seeing in markets today. If you're watching this on YouTube, hit that subscribe button for more content just like it. Huge show for you today. I'm going to run through some of the topics we're going to talk about. Number one, sentiment in the equity market, in the credit markets, definitely getting more frothy. Active managers going all in this week. Number two, I want to talk about pricing in a perfect future, comparing NVIDIA today with Tesla a few years ago. Stubborn inflation. We got that CPI report. It seems very unlikely the Fed's going to cut rates when it meets next week, and probably not in May as well. Number four, the end of negative interest rates. One central bank left in the world with negative interest rates. I think that's going to end next week. I'll tell you why. What is debt and what is growth? I think that's becoming a more important question with the U.S. economy, given how much we're borrowing and spending, a lot more government influence. And so we'll take a look at that. Number six, Bitcoin ETF boom. So really the flows have continued into the Bitcoin ETFs this week. I'll talk about that and maybe a sentiment indicator there as well. Why you need to invest. Number seven, hugely important topic for long-term investors. And number eight, we'll end with something positive, as we always do, the path to prosperity. So let's start out with sentiment. Active managers go all in. And basically what that means is they're going more than 100% long. So if we look at this chart here, you can see the active manager equity exposure over time. This is in the name exposure index. They poll these active managers every week, asking them their equity exposure. And this week, it went over 100%, 104.75%. That's the highest level we've seen since November 2021, which is another sentiment extreme. It was a few months before the peak in terms of the US market, before the bear market. And the fascinating thing here is that sentiment tends to very closely follow price. And when you have a huge price advance, you tend to see sentiment surge higher. So let's go back to just last October when the S&P 500 was around 4,100, so over 1,000 points lower. What were these active managers doing? Well, they were cutting their exposure to equities. They had less than 25% exposure to the equity markets last October during that big correction. And today, the S&P 500 over 1,000 points higher, you have them going leverage long. So we'll see if this is an indicator of something. Very rare to see this type of extreme. These active managers tend to swing this exposure pretty dramatically with a small move. Let's say there's a 5% pullback. They'll probably cut their exposure significantly. But interesting to see this huge exposure after the S&P 500 has run up as much as it has over the past few months. This is not the only thing showing a little bit of froth in terms of sentiment. If we look at the Investors Intelligence Sentiment Index, and this is looking at newsletter writers and determining are they bullish or bearish, or are they in correction mode. And if we compare what it showed this week to where we were in October 2022, when the S&P 500 bottomed during that bear market, there's a huge difference. You can see here the percentage of bulls was only 25% back in October 2022. This week it jumped up over 60%, something you rarely see in the survey. And if we look at the percentage of bears, the opposite, 44% bears back in October 2022. That dropped below 15% this week. So very unusual to see this much bullishness, and very rare to see over 4 times the percentage of bulls as compared to the percentage of bears in the survey. What's driving this? Again, price. If we look at the S&P 500, where it was in October 2022, 3,577, and where it was this week, 5,165. So the S&P 500 has gone up over 44% since October 2022, and these newsletter writers have gotten much more bullish. So you would think the opposite. As a long-term investor, you want to be doing the opposite. You want to be more bullish when prices are down during a bear market, less bullish when they're rising rapidly. But the opposite is always the case with these surveys. And when we look at sentiment, what I always say is only really matters at the extreme. And this is definitely extreme. And what does it mean in terms of forward returns? Well, I'm going to dig into that on the next signal or noise show that I do with Peter Maluk. I'm going to talk about that next week, so stay tuned for that. We'll dig into the data and show you if we're at some type of a signal today in terms of sentiment being extreme, in terms of the levels of greed that we're seeing. So not just the equity markets, we're also seeing the credit markets show complacency or definitely a lack of fear. If we look at high yield credit spreads, so this is the spread between junk bonds and risk-free treasuries, 320 basis points it hit this week. That's the tightest we've seen since January 2022, which was the start, of course, of the bear market. Does this mean we're going to see another bear market start today? No, it's not an exact signal by any means. It could mean that, of course, but certainly this could stay tight for a long period of time. But it's just an indication that sentiment is much, much more optimistic about the future, anticipating lower defaults than it was a few years ago. If we look at during the bear market, where spreads went, if we look at 2020, obviously 2008, and some of these other periods where there was a big amount of fear, where volatility spiked, we're not in that situation today. We're seeing the opposite, where investors are saying things are going to be good. There's going to be low defaults, so we're willing to accept a lower spread on these high risk securities. So that's something to watch, something notable here in terms of the levels of complacency that we're seeing, not just in the equity markets, but the credit markets as well. So let's talk about pricing in a perfect future. And NVIDIA is the stock that everyone keeps asking about, so we have to touch on it again here. In the last 10 years, up over 20,000%. And a lot of people saying, well, it's justified. The fundamentals have increased dramatically, and no question they have. But I want you to focus here on the gap between the price performance and what it's done in terms of net income, which is up around 5,900%, and revenue is up 1,300%. So a far bigger increase in terms of the stock price than these fundamental indications, which means that we have valuation expansion. It's not just fundamentals driving this. We have valuation expansion, and the bullish interpretation would be, well, that's justified because it's forward looking and we're going to see these fundamental indicators catch up with the stock price gains. Perhaps that will be the case, but when it gets to an extreme, when you see an enormous wide gap, that tends to introduce more risk into a security, and arguably we're at that point today. And last week I talked about NVIDIA's market cap almost catching Apple's. It's within a few hundred billion. Apple's market cap only 1.1 times larger than NVIDIA's. And I just want to show you this week a comparison between the current fundamentals of Apple, over 100 billion in net income, largest net income of any US company, and NVIDIA's at just under 30 billion, Apple revenue 385 billion, NVIDIA at 60 billion. So huge gap in terms of the fundamentals, where Apple's net income is 3 times higher, revenue is over 6 times higher, but the market cap is only 1.1 times higher. So what that means, obviously, is that investors are betting that there's going to be convergence in the future in terms of net income and revenue. And I certainly expect these to increase significantly this year. So by the end of this year, we could be seeing 100 billion in annual revenue for NVIDIA, and perhaps a net income number approaching 50 billion, but that's still going to be lower than Apple. So there's an expectation here in terms of the long term. So what a stock ultimately is discounting long-term future profits of the company. And the expectation today is that NVIDIA is going to have not just a short-term jump in terms of its net income, in terms of its revenue, but it's going to, in the next 20 or 30 years, it's going to see significant sustainable increases. And the question for investors is this pricing in too perfect a scenario where nothing goes wrong for NVIDIA over the next 10 to 20 years? And that's a question we can't answer today. All we know is that this gap seems to be very wide. And the last time we saw something like this, I think in a major stock that became the story stock of the market, was definitely Tesla in early 2021, or it reached levels in terms of valuations that were way ahead of its fundamental growth, and investors at the time were pricing in a near perfect future. Now, if we look at forward 1 year price to sales ratios here, I'm comparing NVIDIA to the rest of big tech here. NVIDIA at almost 18 times sales, price to sales, looking at forward. So this is looking at revenues over the next year and taking the current price extremely, extremely high. Microsoft is number two at almost 11 times. That's pretty high as well, but everything else well below that. So NVIDIA, the standout. And so what the expectation is, it's going to see such phenomenal growth that it's going to justify this 1 year price to sales ratio, because not only in the next year is it going to see tremendous growth, but the year after that and the year after that and so on. And the difficulty is it has to constantly meet or beat these expectations. And if we look at something like Tesla back in 2021, the big problem in terms of its valuation, it became to a point where it became very, very difficult to meet those high expectations. It was trading at a forward price to sales ratio of 15, which for this type of company was very, very difficult, because it assumed Tesla was just going to have phenomenal growth, not just the next year, which was likely to happen, but years after that. And what we actually saw with Tesla is its growth started to decelerate. It peaked here at 98% year over year in 2021, right shortly before the stock peaked. And then it starts to trend lower. And where it is today, revenues increased year over year at 3.5%. Now, if we look at what it's done to Tesla stock, well, obviously it's had to reprice because it had such lofty expectations. Those expectations were not met. And what we've seen now is the second longest drawdown and the largest drawdown since Tesla went public back in 2010. It's currently over 800 days. It peaked in November 2021, now 57% below that prior peak. So the question for NVIDIA investors, are there any parallels here to Tesla? A lot of people would argue, no, this is something different. NVIDIA is a different animal. It's seeing much more rapid growth. That certainly seems to be the case based on the numbers. But the question is that gap between price performance and fundamental performance so wide that if anything goes wrong in the next few years in terms of new competitors, or they can't meet demand in terms of ramping up production, or their margins are compressed, or perhaps there's a recession in the economy and companies don't have the money to spend on this AI boom as they are today. Any number of factors could lead to a slowdown, but the market's not pricing in any of those negative factors at all today. So it will be interesting to watch. NVIDIA, clearly the number one story stock and all anyone can talk about today. And as I discussed last week, it's transferred into the semiconductor industry as a whole, where money is just piling into everything, assuming that it's going to be lifting all boats in terms of the industry. So sentiment, very, very frothy in terms of not just the overall equity market, but looking at semiconductors in particular. We'll see in a few weeks if that means anything, and we'll see with that next NVIDIA earnings report, obviously, if it continues to meet or beat expectations, and what happens when it doesn't. So we haven't seen yet the report where NVIDIA says anything negative or hasn't continued to increase guidance. When that happens, I think will be the true test for the stock. Number three, we got to talk about the CPI report here. Stubborn inflation, kind of persisting here. The calls for the Fed to cut interest rates in March pretty much gone. So entering the year, everyone was saying Fed's got to cut in March. The market was saying that. I was arguing no need to cut. Doesn't make sense. We're not there yet in terms of inflation. Now the market seems to be in that camp as well. And I think this inflation report really nailed that down in terms of saying we're not there yet. The Fed does not have enough evidence to say the war against inflation has been won. So what do we get in terms of the report? Well, higher inflation than what was expected. The expectation was for CPI to come in at 3.1%, actually came in at 3.2%, and the core rate of inflation was expected to fall to 3.7%, and it comes in at 3.8%. Now, still, this was the lowest core inflation number since April 2021, so continuing to trend lower, and 3.2% as compared to where we were back in June 2022. Huge, huge improvement, but this is not 2% inflation. And the Fed continues to say they want to see a sustainable path to that 2%. They don't necessarily have to get to 2%, but they have to be confident that they're going to get there and kind of stay there. And this type of report really doesn't deliver that confidence. And it doesn't look like, as I'll talk about in a little bit, it doesn't look like the next month's report, the March inflation report, is going to show a drop below 3%. So we're still looking at above 3% CPI with a Fed who's saying they want it at 2%. Now let's compare it to June 2022, the progress that we've made. It's no small feat here that most of the components, except for shelter and transportation, with a lower inflation rate today than back then. And of course, we have a number that have shown year-over-year declines today, which was a huge difference, obviously, than June 2022. But the big factors here, the biggest one, of course, is that shelter number. It's over a third of CPI. It's getting closer to that June 2022 number. Not there quite yet, but making a little bit more progress over the last month. If we look at the year-over-year rate of change in terms of shelter CPI, down to 5.7%. That was the 11th straight month now we've seen a decline in this shelter CPI number. It peaked at 8.2%. So good to see that progress. But the big question everyone keeps asking is, why is it still so high, even though that U.S. rents, if we look at asking rents, we have data from apartment list, are actually down 1% over the last year. And the answer, as we know, is this is a huge lagging indicator, the shelter CPI. It's looking at data that is lagging. And so the expectation is it will slowly continue to come down, and with a lag reflect the fact that actual rents, if we look at the year-over-year rate of change, have stalled here and are actually 1% lower than a year ago. So fully expect this to continue to trend lower. But the big question is it going to actually fully reflect this? Because we're not just talking about rents. Of course, we're also talking about home prices and home affordability. And that really hasn't changed. So we have kind of two worlds here. We have the rental world, which is becoming more affordable with incomes going up, and rent prices, if we look at asking rents, actually going down. And we have the housing world where home prices continue to go up, hit new record highs. Mortgage rates remain stubbornly high. So if we're looking at the payment it would need to afford the median priced home for sale, well, that is still way, way higher than what shelter CPI is showing, right? So if you've bought a home and you're locked into a low mortgage rate, obviously your inflation rate over the past few years looking pretty good. You have that fixed payment. Yes, your insurance on your home has gone up, your utilities have gone up, the maintenance costs have gone up. All of that certainly has increased for you. But in terms of that mortgage, that monthly payment, that's stayed the same while your income is higher. So those people, yes, inflation's hit them, but not nearly as bad as people who have bought homes over the past few years, or who are potentially going to buy homes. Because if we're looking at the median mortgage payment needed to buy the median price home for sale, you're looking at over a 90% increase since January 2020. So if we talk about housing inflation, it's really, well, whose inflation is it? People who already bought a home, right? Either your mortgage is paid off, or you locked in a low interest rate, or the people more recently who are spending an increasing percentage of their income on that monthly payment. Well, in terms of actual inflation, looking at home prices or looking at the payment needed to afford that price, well, that's way, way higher than shelter CPI. So it'll be interesting to see how this gap gets closed here in terms of, is this going to continue to increase? Is this going to come down? Obviously, it would take mortgage rates coming down or home prices coming down to see this number come down. But you can argue, I think, a lot of different ways that this housing shelter CPI number is overstating now or understating, depend on who you're talking about in the housing market. But no question, it's going to be the biggest factor this year driving that core rate of inflation, given that high rate. Now, if we're looking at the CPI inflation here, we're looking at the Fed's desire to cut interest rates. They've said they want to cut interest rates. They said interest rates have likely peaked. They keep saying that. But here's the problem. They have a 2% target, and we have now 35 consecutive months above 3%. So 3% is not 2%. And if we just kind of hang around that 3% level, that becomes a problem in terms of messaging. They start cutting rates while the CPI is still above 3%, and then it starts trending back towards 4%. Well, that's a situation the Fed really doesn't want to find themselves in. So I think they're going to need to see progress below 3%, moving towards that 2% number before they become comfortable cutting rates or starting that rate cutting cycle. So this is the longest streak above 3%, so longest streak of high inflation we've seen since the late 80s, early 90s. And you can see just a huge long period of benign inflation in the US, and now different environment in terms of a market. So what's the main reason I say the Fed shouldn't be cutting rates at all or thinking about cutting rates? Well, I don't believe 2% target means that if inflation gets back to 2%, then your job is done. No, take it to the extreme. Let's say you have 2% inflation last year, then you have 100% inflation this year, and then you have 2% inflation next year. Does getting back to that 2% number mean anything when you had 100% inflation in between? No, of course not, right? Because you're not erasing that extra additional inflation above 2%. And we could see that here. It's not obviously that extreme, but we're 11% above the 2% inflation trend line. So if we're looking at the beginning of 2020, when this period of high inflation began, we're now 11% above where we would be if we just had 2% inflation. And what that means, breaking that down into years, is we wouldn't have gotten to this level of prices until 2029 if inflation was continuing at a 2% pace. So let's say at some point this year we get down to 2.5%, and the Fed says, okay, we're ready to cut. Well, that doesn't mean that we're at a long-term 2% trend line. We'd have to go below 2% for some period to get back to that 2% trend line. That's what I think the Fed should do. I don't think they will do that because I don't think they care as much about inflation as they say they do. But if we're going to be targeting 2%, you shouldn't be just targeting the rate over the last year. You should be targeting a trend line over a period of time. So let inflation average 1% for a few years before you think about cutting interest rates. We have stock market at record high. We have housing prices at record high. It doesn't seem to be impacting those things. Leave interest rates in a restrictive place for longer so you can make sure that inflation is defeated. And we don't know yet that it's fully defeated, right? We're assuming that just because it's come down to 3%, it's going to go back down to 2% and stay there. But obviously, no guarantee that's going to happen. So what are markets pricing in? They're pricing in now an only 1% probability that the Fed is going to cut interest rates next week. So throw it out, take it off the table. The Fed always does what the market expects it to do. So I'll do my tweet as I always do next week saying that the Fed is going to hold interest rates because the Fed really follows the market 100% of the time. So no chance in March. And if we look at May, very interesting here. A few weeks ago, it seemed 50-50. Now we're at just 7% odds in terms of a May cut. So market almost taking May off the table as well. Obviously, the Fed's comments when it meets next week are going to be influential in terms of where this goes. But market kind of saying, well, inflation's not going to get there in time for the May meeting for the Fed to feel comfortable to cut. If we look at June, this is interesting as well. We now have below a 60% probability of a cut starting in June. A week ago it was 74%, and a month ago it was 82%. So market becoming more and more hesitant to say even the Fed's going to start in June. And entering the year, the market was saying the Fed was going to cut already 3 times by June. So what a difference in just a few months here in terms of expectations. Market was expecting 6 to 7 rate cuts at the start of the year. Now the market's saying only 3 cuts, and maybe that cut won't start until June. We're almost at a 50-50 there. And the Fed, if they want to, they could push this back to July or even later in the year. Now, if we're looking at the expectations for March, and this is the Cleveland Fed expectation, they usually do a pretty good job getting somewhat close to this number. they're expecting CPI not to come down for March, but actually tick up to 3.3%. That's the overall level. Core level, they're saying, is going to be 3.7%. But why is inflation likely to tick up in terms of the March numbers? Well, we're starting to see some pressure from the commodity side. So for a while, we saw gasoline, crude oil, other commodity inputs really pulling down the CPI, and those year-over-year comps now are going to change, where gas prices are right about where they were a year ago, but crude oil prices are now above where they were a year ago, and that is going to turn into a headwind for CPI and likely cause it perhaps to tick higher. We'll see. We're only halfway through the month of March here, but if it continues for the rest of March, we could very well see inflation tick up, and then there's no way the Fed, of course, is going to cut with inflation moving upwards to 3.3% when their target is 2%. And if we look at the producer price index, which, looking at the inputs here, a lot of commodity inputs in here, the expectation was for a 1.2% increase, and we actually came in at 1.6%. So not just consumer prices, but producer prices as well, showing a higher level of inflation than expected. And if we look at that commodities here, I just put it in a chart here. If we looked at a year ago, most of these were in the negative side, and now we're starting to see more push over to the positive side, particularly crude oil being very important, up 20% over the last year. Brent crude, that's WTI crude, Brent crude up 15%. If we look at gasoline, 11% year over year. That hasn't yet filtered. That's gasoline futures, but if we look at the actual price at the pump, that's likely to start showing a year-over-year increase. So the point is, these things were helping pull CPI lower, and if we see a period where commodities start to surge again, well, that's going to very quickly start to put upward pressure, even though we're expecting that shelter CPI to come down. So it'll be interesting to watch. We have crude oil now back above $80 a barrel. So if that makes a run to 90 or 100, everything changes, I think, in terms of CPI, and everything changes in terms of the Fed and expectations for this year. So the end of negative interest rates, this is a fascinating one. Single bank remains. The wave of higher inflation really wiped out many of the European central banks in terms of their belief in negative interest rates. But the Bank of Japan has remained very, very stubborn in saying we're going to keep negative interest rates despite all this evidence that inflation is not positive there, and inflation might be trending higher there as well. We have CPI there at 2.2%, so obviously no deflation. We still have the central bank at negative 0.1%, but that's likely to change again. Consumer prices above 2% here. And this is the big one. This came out this week. Japan's wages here. This is from Rengo. This is the biggest trade union in Japan. And what they said was wages came in over 5% over the last year. So they are seeing accelerating wages here, not likely to lead to deflation here. You're likely to see this contribute to higher prices in terms of Japan. Toyota had a huge agreement with their workers recently, Toyota being the largest Japanese company, and they're paying their workers much more. That was a big deal. And this Rengo just kind of seals the deal, in my view, to say the Bank of Japan can no longer stay in that negative interest rate camp. And my belief for years is negative interest rates make absolutely no sense. You can't have a negative rate of interest. It's not good for anything. It distorts almost everything in the economy. And so I think it's actually a good thing that they're going to likely move off it next week. That's the expectation. They're going to hike rates back above 0%, take it back into positive territory. And the biggest factor driving that will be those wage increases. And that will be the first time that the Bank of Japan hikes rates since February 2007. They had this negative interest rate policy since February 2016. And if their goal was to create inflation, well, I'm not sure that negative interest rates did it, but they now have inflation. And so it seems crazy that they would keep it. And so very likely, I think they'll see a hike next week. And will be out of the negative interest rate era for now. And so only a few years ago, you had all of these banks, the ECB, Bank of Japan, Switzerland, with negative interest rates. And today, very different story. And so perhaps a very different period here in terms of inflation, not just in the US, but around the world in terms of being higher, perhaps for longer. And number five, we got to talk about debt and growth. This is a big factor with the US economy. A lot of people saying, well, why are we seeing these rates of growth? What's driving this? Why aren't interest rates having a bigger impact? And I think one factor you have to point to over and over again here is the fact that we're running almost $2 trillion deficit, despite the fact that the economy is still in an expansion. And that's kind of circular because part of why the economy is growing is the fact that the government is borrowing and spending so much money. And uh, that might seem counterintuitive, but it shouldn't be because part of the calculation for GDP is government spending. It's part of the equation. So it's not just the private sector. If the government borrows a ton of money and they push it out into the economy, that's going to contribute to growth. In the long run, when you get to a certain debt level, that's been shown in many countries to lead to a decrease in growth. But in the short run, it feels very, very good. You get a boost from it, right? There's no penalty. You're borrowing that money and you're pushing it out into the market and you're pushing it out into the economy, and it contributes to higher GDP growth. The problem in the long run, of course, becomes when that level of growth starts to crowd out that level of debt starts to crowd out productive areas of investment. And that usually arises when you have a spike in the interest payments on that debt. And speaking of which, we seem to be getting closer to that point here. We're at now over $1 trillion in terms of the spending on interest alone on the public debt over the last 12 months. It's the first time we're above $1 trillion, more than doubling over the last few years. So huge increase. Why haven't we felt the pain of this yet? Well, because we're simply borrowing the money to pay the interest on the money. So we're not pulling back just yet. It isn't crowding out spending just yet. We're just borrowing more of it to service it. So at some point, I think there'll be some pushback, and that will lead to a tighter fiscal policy. But for now, the government seems to be willing to spend money on just about anything. And in terms of retail sales, we got some interesting data this week. Again, I don't like to look at any one month, but we noted last month that there was a drop, and this month there wasn't a huge rebound from last month. So we're still at a negative level in terms of inflation adjusted retail sales, well below the average, negative 2%. And if we look at nominal retail sales, up less than 1% over the year. So last year. So potential weakness there. We talked about the consumer, talked about rising credit card interest rates. So perhaps rising credit card interest rates and rising auto interest rates and these other things, perhaps leading to this pullback in consumer retail sales. And if we look at expectations for GDP, it's very hard to have a negative GDP number when the government's borrowing and spending as much as it is. And the expectation for the first quarter is indeed another quarter of growth. Above 2% is the Atlanta Fed expectation. Now Wall Street is expecting the same. If we go back, enter the year, the blue chip consensus was less than 1% for the first quarter. Now they're up to 2%. And so we'll see. Still a few more weeks left in the quarter, but the expectation is another positive GDP growth. So the expansion continues. Bitcoin, I have to discuss it. Another big sentiment week for Bitcoin. Had a few people reach out to me. I haven't heard them ask me about crypto in a few years. So it's been a while since the interest in crypto has been as high as it is today. And what's driving that same thing is why people are asking me about Nvidia. And the last time they were asking me about stocks was during the mania phase of 2021. It's that prices go parabolic, and you have this FOMO set in, and it's happening, as I discussed last week, in a number of asset classes. But the two biggest ones seem to be Nvidia and Bitcoin. And if we look at the advance over the past few months, just tremendous, obviously. And when it's crossing above these big milestones, it becomes very, very difficult to ignore. So it gets back to a new all-time high, it gets to 69,000. And this week it hits a few more, 71,000, 72,000, 73,000, right? So that's what you're hearing every day. Bitcoin only goes up, and you have these ETFs products where people can easily buy them. And that's what retail is doing. And as I talked about last week, the 11 spot Bitcoin ETFs were coming close to the largest gold ETF in terms of AUM. And this week they surpassed it, hitting 60 billion. So now over a few billion more in these spot Bitcoin ETFs than the gold ETF. So very quickly, more than doubling in terms of assets in these Bitcoin ETFs. And if we look at the time it took for the iShares Bitcoin ETF to cross above 10 billion, it took just 7 weeks to go from launching this product to go above 10 billion. That's the fastest ever for an ETF. And very interesting, the prior record was held by the gold ETF, the GLD, and it took 27 months when it launched in 2004 to cross above 10 billion. So much, much shorter period of time. Obviously, the assets today, inflation adjusted, there's a little bit of a difference here, but it just shows you the huge demand, the huge sentiment pouring into these products in terms of retail investors who obviously weren't comfortable buying the physical spot or spot Bitcoin in terms of opening a Coinbase account or something else. They were waiting for this ETF product, and you can see here just huge, huge inflows in a short period of time. And what I would remind these investors that are getting in today in terms of Bitcoin, Bitcoin has risk. Bitcoin has volatility. Just remember that. Be prepared for that. If you're buying into this today, this is a history of Bitcoin corrections. Last one was 78%. And will that happen again? When will it happen again? We don't know, but you should certainly be expecting 30, 40, 50% corrections at some point if you're a Bitcoin investor. Here's a chart going back to 2014 in terms of Bitcoin's drawdowns. You can see how many times bigger drawdowns than 60%. And now we're back to an all-time high, and it feels like, well, that'll never happen again. But of course, anything with these types of gains, this type of volatility, you should be fully prepared and fully expecting it to go down 30, 40, 50% at some point. And particularly, you should be prepared for that when sentiment is where it is today, where the asset class seems like it can't do any wrong, and you have retail investors euphoric about it. But when it was down 80% and FTX was failing, those same investors had absolutely no interest in it. So when Bitcoin was at 15,000 back then, they could care less about it. Now Bitcoin's above 70,000, and all of a sudden they want to get in. So just be prepared. If you're looking at Bitcoin, understand the risk, understand what you're investing in, and be prepared for huge, huge corrections and drawdowns along the way, because there's no such thing as upside without downside. And that's true in any investment that you make, but it's particularly true when you have an investment as volatile as something like Bitcoin. So let's talk about why you need to invest. And I think a big part of this is that same inflation story that we've been talking about. And the one prediction I will make over the next 30 years is that prices will be much higher than today. And the reason for that is that there's going to be inflation. If we look at the last 30 years, the value of your dollar has gone down in the US by over 50%. And the US has been better than most countries in terms of purchasing power, and it's still been cut in half over the last 30 years. So, how do you protect yourself against this? Well, if you have money under your mattress, you have money in a checking account that's earning no interest, that's not going to do it. If you want to keep pace with inflation, have a chance to outpace inflation, you have to be an investor. And historically, the best way to do that has been in the stock market. If we look at the S&P 500 in the last 30 years, it's actually outpaced inflation by 840%. Not every year, certainly not every year, and certainly not every 5-year period, but over a long period of time, the S&P 500 tends to do very well against inflation. It's actually returned over 7% per year over the last 30 years above the rate of inflation. Now, that's much higher than normal. I wouldn't expect that over the next 30, but the point is, This is why you need to invest. If you want to have the same level of purchasing power, if you want to build real wealth over time, the best way to do that is to be an investor. So if you're thinking about inflation, and you should be in the future, and you have goals in mind for retirement, for your kids, for many other different things, and you're looking at an advisor, or you have an advisor and you want a second look, well, reach out to us at Creative Planning. We have over 300 billion in assets under management and advisement. We're in all 50 states, and we take a look at everything in terms of your portfolio, your other assets, in terms of real estate. We put it all together and come up with a portfolio and a plan that's customized for you. So take a look at the show notes. I'll have a link there. Reach out. We're here to help. I want to end, as I always do, with something positive, and that is that we're still on the path to prosperity. We're back on the path to prosperity. What do I mean by this? Well, wages are outpacing inflation. So yes, inflation was worse than expected in February, but the good news is that wages are going up more than that inflation rate, over 1% more to be exact. And that was the 10th straight month in the US where wages have outpaced inflation. And that follows a period where it was pretty difficult. We had 25 consecutive months of wages coming in below the rate of inflation. That's why sentiment was so negative. It felt like a very, very downward spiral in terms of people saying, how am I going to get out of this? This prices are going up so much and my income isn't going up nearly as much. Well, now we're seeing the opposite, where incomes are going up more than inflation. And this is a big reason I want to keep this going here for months and years to come, why the Fed has to hold the line and really be concerned with inflation first. Right? If inflation gets back up to 4 or 5%, it's going to be very hard for companies to increase wages above that level. If we keep inflation at 3% or below, going to be much easier to stay above that. And that's really in the long term what contributes to prosperity for a nation. Well, it's wages outpacing inflation. That's the improvement in purchasing power and quality of life. So let's keep this going and let's hold the line here in terms of inflation. And best news in terms of the CPI report, in my view, was the fact that food price inflation, looking at the grocery store, another moderation in terms of the rate of inflation here. We're now down to 1% over the last year. So if you're earning 4% more than a year ago, which is the average in the US, and if food prices have gone up 1% over the last year, well, the good news is that's relatively cheaper. No, the price is not coming down. It's still 1% higher than last year, but we're moving in the right direction. And as I said many times here, I'd love to see this go negative. And a lot of people are worried and afraid of deflation, but we had this go negative on a year-over-year basis back in 2016, 2017. We had it go negative on a year-over-year basis in 2009 and 2010. Wasn't in the end of the world then, won't be the end of the world today. So let's see prices actually come down a little bit on a nominal basis. And as I talked about, that's getting back to that long-term trend. If you want to get to 2% trend line, you got to be below it for a period of time. But great news here in terms of food prices. Food away from home, restaurant prices still going up much higher than this in terms of their rates of increase. But if you're going to the grocery store, this is a huge upside surprise, I think, from where we were a year ago. The fact that it's come down to 1%, and hopefully at some point this year it'll be negative. So with that, we'll end it right there. Thanks everyone for watching. If you're watching this on YouTube, hit that subscribe button for more content just like it. Have a great weekend, and I'll see you next time on the Weekend Charts.